$8 trillion. That is the number Wall Street does not want you thinking about right now. Not the inflation rate, not the unemployment figure, not the latest earnings beat from a tech company. $8 trillion. That is the magnitude of wealth that could be erased from American portfolios, retirement accounts, and pension funds if the man who runs the largest bank in the United States is correct. And this man does not make public warnings for attention. He does not post on social media to chase clicks. He runs a bank with over $3 trillion in assets, a bank that processes more financial transactions in a single day than the entire economy of most countries does in a year. When Jamie Dimon, Chief Executive Officer of JPMorgan Chase, tells the world that the probability of a serious market crash is far higher than the 10% currently priced in, every person with $1 invested anywhere in America needs to stop and listen. The math is not complicated, and that is exactly what makes it terrifying. The Standard & Poor's 500 Index, the benchmark that represents the heartbeat of the American stock market, currently holds a total market capitalization of roughly $42 trillion. A serious correction, the kind Dimon is describing, means at minimum a 20 to 30% decline. Run that calculation and you arrive at $8 to $12 trillion in paper wealth that disappears. $8 trillion is not an abstraction. It is the combined retirement savings of tens of millions of Americans who followed the conventional wisdom, stayed invested, trusted the institutions, and believed the headlines that told them everything was fine. Those people are about to discover that the headlines were written for them, not for the people who actually move markets. But here is where the story gets more dangerous. Dimon's warning does not exist in isolation. It arrives at the exact moment that three separate forces are converging on the American economy simultaneously. Three forces that individually would be manageable. Three forces together that create the conditions for the kind of systemic break that only happens once or twice in a generation. Wall Street knows all three of these forces exist. Wall Street is not talking about them because Wall Street needs you to keep buying. Before we expose exactly what these three forces are, how they interact, and what the specific data points are that Dimon is watching inside his own institution, make sure you are subscribed to this channel and have turned on the notification bell. We track these developments daily. When the next major signal fires, you will be the first to know. Comment down below with stocks or gold to tell us where you are moving your money right now. We want to see exactly how our audience is responding to what is coming. Let us begin with who Jamie Dimon actually is, because the credibility of the warning matters as much as the warning itself. JPMorgan Chase is not just a bank. It is the central nervous system of the American financial economy. Every major corporation in America has a relationship with JPMorgan. Every major institutional fund trades through JPMorgan. Every major credit market flows through JPMorgan. This means that Dimon and his risk team have access to real-time economic data that no government agency, no research firm, and no media organization can match. They see corporate credit card spending before it shows up in consumer confidence surveys. They see corporate loan drawdowns before they show up in GDP numbers. They see delinquency trends before they show up in official government filings. When Dimon stands before reporters and says the crash risk is far higher than the market admits, he is not reading the same reports you can find on a financial website. He is reading the internal data of the most sophisticated financial surveillance network on the planet. That is why this warning is different. The first force that is building pressure toward Dimon's predicted correction is what we can call the tariff trap. President Trump's aggressive tariff escalation in 2026 has created a scenario that is structurally different from anything the modern American economy has navigated before. Tariffs are not just a trade policy. They are a hidden tax on every American consumer and business that buys imported goods. When you impose tariffs broadly across multiple major trading partners simultaneously, you inject a structural inflationary force into the economy. This is not a temporary price spike. It is a permanent repricing of the cost structure for American businesses. Input costs rise, margins compress, profit guidance gets cut. And this is happening at the worst possible moment for a very specific reason. The Federal Reserve is completely paralyzed by this tariff-driven inflation. At its January 2026 meeting, the Federal Reserve held its benchmark interest rate steady at 3.5 to 3.75%. The stated reason was that the economic outlook had improved. The real reason is that the Fed cannot cut rates while tariff inflation is running through the system. If they cut, inflation reaccelerates. If they hold, the economy slows toward the recession that Dimon is warning about. This is the policy trap that sophisticated investors have been modeling behind closed doors for months. You are pressing the gas and the brake at the same time. Something breaks, and BlackRock, the largest asset manager on Earth with over $11 trillion under management, published its own warning confirming this reality. BlackRock's base case for all of 2026 is only 25 to 50 basis points of rate cuts for the entire year. That is 1/4 to 1/2 of 1%. In a world drowning in debt, that is not relief. That is a death sentence for borrowers who were counting on normalization. The second force is the valuation trap that nobody in the mainstream financial media will explain to you honestly. The price-to-earnings ratio of the Standard & Poor's 500, the measure of how expensive stocks are relative to the actual profits of the underlying companies, is sitting at historically elevated levels. Investors are currently paying approximately $22 to $24 for every single dollar of annual corporate earnings. In a zero-interest rate world, that can be justified because there is nowhere else to put money and you have to pay a premium for growth. But we do not live in a zero-interest rate world. We live in a world where the Federal Reserve is holding rates at 3.5%, where short-term Treasury bills yield over 4% with zero risk. The fundamental question that Wall Street is refusing to ask out loud is this: if you can earn 4% per year with absolute safety buying a government bill, why would you accept a 4.5% earnings yield on a volatile stock market? The rational answer is that you would not. You would demand a higher earnings yield from stocks, which mathematically means lower stock prices. The valuation compression required to make equity yields competitive with current risk-free rates is not a small adjustment. It is the 20 to 30% correction that Dimon is warning about. The math has been broken for months. The only thing keeping prices elevated is the collective decision of institutional investors to pretend the math is not broken. That pretense has a shelf life, and Dimon is telling you the shelf life is running out. But the story does not stop there. The third force is the one that transforms a correction into a crisis. It is the debt maturity wall that is colliding with the American economy in 2026 with the force of a financial hurricane. $2 trillion in corporate and government-related debt obligations are maturing this year. $2 trillion in loans, bonds, and credit facilities that were originated in the era of near-zero interest rates that must now be refinanced at today's rates. A corporation that borrowed $100 million at 2% in 2020 is now walking into a bank and being told the new rate is 5.5%. Their annual interest expense does not go up a little. It triples. For a company running on thin margins in a tariff-pressured environment, that tripling of debt service cost is the difference between a functioning business and a business that is racing toward the edge of insolvency. Here is where it gets worse. This is not a problem affecting one company or one sector. $2 trillion of simultaneous refinancing is systemic. It is every sector at once: corporate bonds, commercial real estate loans, leveraged buyout debt, infrastructure financing, all of it maturing at the same time, all of it needing to be refinanced at rates that have more than doubled since the original loans were written. The banking system is not built to absorb this volume of credit stress simultaneously. It was built for the world that existed before 2022, when rates were near zero and refinancing was a routine administrative exercise. That world is gone. The new world is a world of 3.5% benchmarks and $2 trillion of debt coming due at the same time. This is the specific data point that Dimon is watching inside JPMorgan's loan books. He sees the refinancing requests coming in. He sees the gap between what borrowers need and what the math allows. And he is telling you the gap is bigger than anyone wants to admit publicly. But the real danger lies one layer deeper than the corporate debt market. Because when corporations begin to fail under the weight of their refinancing costs, The cascading consequences move through the economy in a very specific order. It begins with earnings disappointments. Tariff pressure plus debt service pressure equals margin compression. Companies that were reporting strong profits begin to miss estimates. Guidance gets cut. Stocks reprice. This is stage 1. But stage 1 triggers stage 2 almost immediately. As stock prices fall, the wealth effect that has been holding up consumer spending begins to erode. American households hold more of their net worth in equity markets than at any previous point in history. When your 401k balance falls 20%, you feel poorer. When you feel poorer, you spend less on discretionary items. When discretionary spending drops, revenues fall for the consumer-facing businesses that make up the backbone of the American service economy. Stage 2 triggers stage 3. As revenues fall, companies face a choice between defending margins and defending employment. History tells us they defend margins first. They cut labor costs. Unemployment begins to rise from its historically compressed levels. And here is the trap inside the trap. When unemployment rises, it creates a second, independent wave of spending contraction. Now you have two simultaneous forces pulling the economy down: market wealth destruction and labor market stress. Each one makes the other worse. This is the negative feedback loop that central bankers fear more than any other single outcome. And the Federal Reserve is watching this spiral form with its hands effectively tied by tariff inflation that prevents the rate cuts that would normally break the cycle. This brings us to the third stage consequence that almost nobody in the mainstream press is connecting to Dimon's warning. Regional and mid-sized banks across America are currently sitting on significant concentrations of commercial real estate loans that are themselves caught in the debt maturity wall. The first bank failure of 2026 has already happened. Metropolitan Capital Bank and Trust in Chicago was seized by Illinois regulators in January, tied directly to a troubled commercial real estate loan. This is not a random event. This is the first domino in a sequence that has $57.7 billion of commercial mortgage-backed securities sitting in default risk territory right now. And nearly 70% of all commercial real estate debt in America is held by exactly the kind of regional and community banks that do not have the diversified revenue streams of JPMorgan or Bank of America to absorb massive write-downs. When a regional bank takes a series of significant losses on commercial real estate loans, it does two things simultaneously. First, it reports those losses to regulators, which triggers increased scrutiny and capital requirements. Second, and more importantly for the real economy, it stops lending. It hoards every available dollar to cover its potential future losses. This is the credit crunch mechanism that transforms a financial problem into a Main Street problem. Small businesses that need a loan to cover a slow quarter find the bank officer polite, but the answer consistently negative. Contractors who need a line of credit to take on a large project are told the credit committee has tightened standards. Entrepreneurs who have a viable business plan cannot get the capital to execute it. This is not a hypothetical future scenario. This credit tightening is already happening in communities across America right now. The banks are not advertising it, they are quietly pulling back. And the economic slowdown that results does not show up in the official statistics for 3 to 6 months, which is exactly why Dimon can see it coming before the rest of the market does. But there is a third front opening in this financial war that Wall Street is not discussing at all. The credit default swap market, the professional insurance market for corporate bonds, is showing rising stress in sectors that the equity market is still pricing as healthy. Credit default swaps are not retail instruments. They trade in the over-the-counter market between institutions with billions of dollars at stake. The professionals who price these instruments are not influenced by the same incentive structures that drive the equity market. They do not earn fees by convincing retail investors to stay bullish. They earn by accurately pricing risk. And right now, the risk pricing in the credit default swap market is diverging from the risk pricing in the equity market. Bonds and stocks are telling two different stories. This divergence is a pattern that has appeared before every major market correction in the last 30 years. It appeared in early 2001, months before the full equity collapse. It appeared in mid-2007, months before Lehman Brothers fell. The bond market is always right before the equity market admits the truth. It takes longer for stocks to accept reality because stocks are driven by sentiment and momentum, and the relentless optimism of commission-driven salespeople. Bonds are driven by cold mathematical default probability. And this brings us to perhaps the most uncomfortable fact about who bears the cost when this correction arrives. It is not the hedge funds. They are already repositioned. It is not the endowments and sovereign wealth funds. They have already adjusted their allocations. It is not the billionaires. Warren Buffett's Berkshire Hathaway built its cash reserves to the highest absolute level in the company's 100-year history over the last 12 months. That is not conservative portfolio management. That is a man who has survived every market cycle since the 1960s, looking at the current risk-reward equation and deciding that cash is better than any available alternative. When Buffett holds record cash, he is voting with the only currency that matters. The people who bear the cost of the correction are the 40 million Americans who have more than 80% of their retirement savings in equity-heavy index funds. The people who are 5 to 10 years from retirement and cannot ride out a multi-year bear market. The teachers, the nurses, the small business owners who followed the advice of every financial advertisement they ever saw and stayed invested for the long run. They are the counterparties to the institutional repositioning that is happening right now. They are the people still buying as the smart money quietly exits. Your retirement account is not protected by the fact that it is in a fund. Your pension is not protected by the fact that it is managed by professionals. Your life savings are not protected by the fact that they sit in an institution with a recognized name on the door. What protects your financial future is understanding the risk you are actually carrying and making informed decisions before the market forces those decisions at the worst possible prices. The Federal Deposit Insurance Corporation insures individual bank deposits up to $250,000 per depositor per institution. But what most Americans do not know is that the FDIC Insurance Fund holds only a small fraction of total insured deposits at any given time. In a scenario where multiple regional banks fail simultaneously under the weight of commercial real estate losses and debt maturity stress, the FDIC's capacity to respond quickly is limited. This is not a theoretical risk. The Dodd-Frank Act of 2010 contains provisions for what regulators call orderly liquidation, commonly known in financial circles as bail-in. Under bail-in mechanisms, certain categories of bank liabilities can be converted to equity in a failing institution before taxpayer funds are deployed. This is the legal framework that allows the financial system to absorb bank failures without immediate taxpayer bailouts. The consequence for depositors above the FDIC limit is that their deposits can theoretically be converted to worthless equity in a bank that is failing. The window to protect yourself from this scenario is open right now. The window will close when the crisis makes headlines. So what do you actually do with this information? There are 4 concrete steps that protect your financial future without requiring you to liquidate your entire portfolio or make dramatic changes you will regret if the timeline extends longer than anticipated. Step 1. Audit your banking relationships immediately. Do not hold more than the federally insured limit in any single institution, particularly any institution with significant exposure to commercial real estate loans. Spread your liquid cash across multiple systemically important institutions that the government has an implicit mandate to protect. This is not paranoia. It is basic risk management that every sophisticated institutional investor practices automatically. Step 2. Examine the duration and composition of your investment portfolio with fresh eyes. Holding 20 different equity funds is not diversification. It is concentration in a single asset class that moves together in a risk-off environment. True diversification in the current environment means holding assets whose performance does not correlate with the equity market. Short-duration treasury bills yielding over 4% are a compelling alternative to equity risk when the potential downside in stocks is 20 to 30%. Gold, which has been reaching toward all-time highs as central banks globally accumulate physical metal at the fastest pace in 50 years, provides insurance against the scenario where the Federal Reserve is eventually forced to restart quantitative easing to bail out the banking system, which would be deeply inflationary for hard assets. If you are going to hold gold, hold physical gold, not an ETF, not a fund. An ETF is a claim on a bank. A physical coin in your possession is an asset with no counterparty risk. In a systemic crisis, those two things are not the same. Step 3. Address any floating rate debt in your personal balance sheet as a priority. Variable rate credit card debt and adjustable rate mortgage obligations are the personal finance equivalent of the corporate debt maturity wall. If rates stay elevated, your cost of carrying that debt increases every month. Eliminating variable rate obligations converts uncertainty into a fixed, predictable cost structure that survives any interest rate environment. Step 4. Stop waiting for the official announcement that the crisis has begun. By the time the crisis appears in headlines and official government statements, the capital has already moved. The institutions have already adjusted. The people who took action before the announcement are already protected. The people waiting for official confirmation are the people who find the bank's online portal showing unusual delays on a Monday morning. Do not be that person. Do not be the last one standing outside the branch when the sign says closed. Ray Dalio said in February of 2026 that the global systems that allow money to flow freely between nations are beginning to break down. He called it a capital war. Jamie Dimon said the crash risk is far higher than the 10% priced into the market. Warren Buffett is holding more cash than at any point in the 100-year history of Berkshire Hathaway. These three men control more capital and have access to more economic data than any other three people on this planet. They are not coordinating. They are not conspiring. They are independently looking at the same underlying data and arriving at the same conclusion through separate processes. When the most informed observers of the global economy converge on the same warnings simultaneously, the probability of all three being wrong becomes vanishingly small. The conditions for a serious market correction are not building. They are already in place. The tariff inflation trap is preventing the Federal Reserve from providing relief. The debt maturity wall is generating a credit crunch that will hit Main Street before it hits Wall Street headlines. The valuation math is broken, and the bond market knows it even while the equity market is still pretending otherwise. The first bank failure of 2026 has already happened, and the commercial real estate losses that caused it are not contained. They are spreading through the regional banking system quietly right now, the same way the subprime losses spread through 2007 before the public realized what was happening. You now have the information that the mainstream financial media is not giving you because giving it to you honestly conflicts with the incentive structures that keep the financial advertising industry profitable. What you do with this information determines which side of the great wealth transfer you end up on. The wealth being transferred right now is moving from the hands of the complacent to the hands of the prepared. It is moving from the people who trusted the headline to the people who read the data behind the headline. It is moving from the people who waited for official confirmation to the people who acted when the warning was issued. The warning has been issued. The captain of the largest financial ship in America has told you the waters ahead are far more dangerous than the passengers realize. The question is whether you are watching from the deck or quietly moving toward the lifeboat. Thank you for watching this breakdown of the most significant financial warning issued by any major banker in the past 12 months. If this analysis changed your understanding of the risks in your own portfolio, please share this video with anyone you know who has savings in the stock market, a 401k, or money in a regional bank. They need this information, and the mainstream algorithm is not going to deliver it to them. Subscribe to this channel and turn on the notification bell so you receive the next alert the moment new data confirms or changes the picture. We track this crisis in real time every single day. Together we navigate what is coming. Together we protect what we have built. Together we emerge from this with our wealth and our freedom intact. I will see you in the next video.